The blue chips, the S&P 500, have kept strong right up to the last second, and wave after wave of the stocks that had made the real running peel off and drop. In 1929, the flakes were down for the year before the market broke. They were down 30%. The year before, they'd been up 85. They had crushed the market. The really classic example of this is the Russell 2000, which is stock number 1,001 to 3,000. They're multi-billion-dollar companies. They're a serious enterprise. In the last year, they are down. They have not made any money at all. The S&P's made 23%. The Russell 2000 is meant to go up about 1.2 times the market. In a bull market like you're saying there was, it should have been up about 30%. It wasn't even up recently. This is a huge divergence of a kind that has never happened other than the super bubbles of 1929 and 2000. 2000, you may remember, the growth stocks peeled off and were down 50%. The S&P was flat, which meant the remaining 70% had risen 20%. This is an enormous divergence, and it happens on the upside for the blue chips. When I sat down a year ago, we had seen the accelerating phase that you need in a bubble. That had taken place last year with the NASDAQ up over 100 from the low, but also up 58% from December of 2019. So even granted that COVID decline, it was a hell of a year. It was a year of acceleration. And the NASDAQ has started to weaken relative to the blue chips. The Russell has started to weaken much more so. I think we're now in the buy the dip mode, which the super bubbles specialize in. You don't have 2 years of buying frenzy dying overnight, typically. So even in 1929, you had some magnificent rallies. And buy the dip is the watchword of practically every brokerage house out there. And it always is. You never, almost never, have a major brokerage house say the game's over. It doesn't happen. The commercial imperative is overwhelming to stay bullish. It's how you make money. The trend line, being slightly generous, is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the NASDAQ came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend line. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level. And of course, it declined very quickly, 50% in 1929. It declined 50% in 3 years in 2000. And the housing market, which was another great American super bubble, went all the way back to trend in 3 years. As I said a year ago, I think they'll do pretty well by selling. I'm sympathetic to how difficult it is to get out entirely out of equities. And I would point out, as I did last year, that there are less overpriced parts of the equity market around the world. In fact, everywhere is less overpriced than the US. The US is the peak of this bubble as it was in 2000. And what it meant then is what it will mean today, and that is the US will decline a whole lot more than the rest. It's also true that the value end of the spectrum, as opposed to the growth end, is about as cheap as it gets. So if you can combine those by buying value stocks outside the US, I would say particularly emerging markets, but there's quite a few countries, Japan, the UK, where the markets are. If they're overpriced, they're only moderately overpriced. The US is not moderately overpriced. It is shockingly overpriced. We are indeed short a decent amount of Russell 2000s. So we haven't been hurt in the last year, which is amazing. We're also short about half as much again as in the NASDAQ, which did hurt us, but not sensationally. And the point there is a lot of our money is in venture capital. That's very growthy. We need some hedging. And if we weren't exposed to a large amount of growth stocks, I suspect we would skip the hedging. We would skip going short. The same in 2000. We were basically recommending that you ease up on US equities by mid-98. And that was a hell of a rally, and that was brutally painful. But it was still a level where you made tons of money. By 2002, the market was much lower than that. A standard bubble we defined over 20 years, perhaps 25 years ago, as a 2 sigma statistical event. It's just a measure of how much of an outlier you are. 2 sigma is the kind of deviation that should occur every 44 years. And because we're a little wilder and less efficient than we should be, it occurs every 35 years. Super bubbles can really wipe you out like 1929 did. And that's where we are now. We entered a few months ago into 3 sigma territory, super bubble territory. And the other great risk is last year we also entered bubbles in real estate. So this is a very dangerous year that we've just had. Some bubbles are very specialized to US growth stocks, like 2000. And they hurt. There is a wealth effect. People lose money, they pull back on their spending. But they don't hurt anywhere near as much as when you combine that with a housing bubble. So in 2008, where we had the only housing bubble in American history, that burst and the stock market came down 50% in sympathy. Then you're talking serious damage to the economy through the income effect. So we have a housing problem, we have a stock market bubble like 2000, we have overpriced commodities, oil is 88, and we have, of course, the lowest real rates in the history of man. Now you have a much higher ratio of debt to GDP. You have much more debt on the balance sheet of the Federal Reserve, and you have much lower rates. I haven't written about inflation for 20 years. When I did quarterly letters, I never featured inflation. I didn't think it was on the radar screen. It is now on the radar screen once again. It's not that inflation will go roaring back to 1972 or 1982. It's that it will always be part of the discussion from now on, in my opinion. Instead of forgetting about it, it will be spiking and irritating and falling back and then spiking again. It will be part of the scenery in the way it used to be in the second half of the 20th century. We're in the early stages of running out of raw materials. Of course, we live on a finite planet. There's only a certain amount of cheap oil, cheap nickel, cheap copper, and we're beginning to hit some of those boundaries. So we're going to live in a world of bottlenecks and shortages and price spikes, and we have to get used to it and learn to manage our way around it. There is a lot of regulatory capture where people from business tend to run the agencies that regulate the industries. So it's been a wonderful time to make money at the corporate system, and the share of GDP that goes to corporate profits has steadily risen, and the share going to labor has steadily fallen. This makes it a dreadful cousin with the asset class inflation that we've had. They both have 2 things in common. They make the rich better off, and they make the working class worse off.